So in this discussion, we're going to be reviewing the 2007 General Ledger. If you've not already reviewed the 2006 General Ledger, you're going to have a hard time following what we're doing because we did some things in 2006 to show how they were handling their books and records, and so you need to go back and review that first and then come back here and look at this. So like in 2006, we have a general ledger here that just has this one consolidated massive general ledger that hits practically every account with an increase or decrease. It is recording all the deposits for the year and all the payments for the year. So we see this sort of naked journal entry. It has no date, it has no description, it doesn't have all the typical trappings that a responsible journal entry would have that would help you understand it, but this one is completely blank. It just has the numbers. And the debit is the increase to the checking account to cash, and that's for all the deposits for the year. And then the credit is the decrease to cash, that's for all the payments. And so all the deposits would presumably what they collected from customers, so you would credit revenue for that piece. Any loans that they got, the cash payments would be maybe for assets and for expenses that they were paying, and so you would record those as debits to offset those payments. It's pretty difficult to review a general ledger where all the pieces and parts are across 2, 3, 4, and 5 pages. So in order for me to be able to inspect it and make any sense of it, I reconstructed it like I did for 2006 and put it all on one page so I could study it. And so I took all the debits and credits in each of the accounts and I recorded them in Excel and organized them so I could inspect them. So here they are here. So the large composite entry to record all of the deposits and all of the payments shows cash going up a little bit more than sales revenue. We bought a little bit of equipment, apparently the client did. The client is reversing last year's payroll liability and sales tax liability and setting up this year's payroll liability and sales tax liability. They're recording the dividend that they paid. They are debiting retained earnings. Apparently when they pay for prior year expenses, they put that amount to retained earnings to revise the prior year. Not a great practice, but what this client is doing. And then we see all the other things that they paid for. The purchases of inventory that they're writing off to cost of goods sold, advertising, auto lease, delivery, and so forth. All these various expenses that they paid for during the year. And then after year end, they did a number of journal entries, a number of adjusting entries. Let's take a look at those. In February, they adjusted the inventory and cost of goods sold account, presumably based on the physical count that they did at year end. And they recorded their depreciation expense. That looks pretty ordinary. In March, however, we have a very strange entry that reduces sales and sets up a liability. Sets up a payroll liability of $15,000 and a long-term debt of $10,000. That entry makes no sense to me, that we would have reversed a sale in order to record that we owe another party. We have a liability. So that entry doesn't appear to have any business purpose that would make any sense to me. Let's look at the one on March 9th. Here they are removing some auto lease expense and putting cost of goods sold. That doesn't make any sense to me. They are reducing travel and entertainment expense and putting in advertising. Not sure what the purpose of that would be. And then they're removing outside labor expense and putting it in insurance. So those three reclassifications from one expense account to another expense account don't make any sense to me. So I would want to ask in the interviews why were these adjusting entries made and what the business purpose would be. So now we can add to the list of things from the 2006 General Ledger that we want to ask about in the interviews. So we want to ask about why they eliminated the $25,000 in sales and set up a loan and a payroll liability. We would want to know why they removed the amount from the auto lease account and put it in cost of goods sold. We want to know why they took the $12,005 out of travel and reclassified it to advertising. We want to know why they took the $5,000 out of outside labor and put it to insurance. And then, just like in 2006, we want to know about what level of receivables, pawn loans, because we know they're not recorded, about what they were. We want to know about how many pawn items they have that are not in the general ledger, because they don't count them. And of course, we want to know if there's any cash that hasn't been deposited related to pawn loans. So we will be asking about that in the interviews. Our next discussion, we're going to be talking about the 2008 general ledger.